This is Hillary Kramer. We are here at the Dallas Money Show. I am speaking with Louis Navellier, a esteemed investor, stock analyst, and overall guru, and perhaps the father of stock. Oh wait, can we start that again since it's not live? I'm trying to give you like the best, but I'm just trying to.
Yeah, you're
I want
to finance. Yeah.
I need to. The best.
It gets tough.
Okay, because I don't want to be insincere, and I don't want to, I want to be genuine. And when you start using too many superlatives.
Okay, stand by. And here we go. In 3, 2, 1.
I am here at the Dallas Money Show with Louis Navellier. Louis is the most esteemed stock investor and guru of the markets and has been in this quite a long time. He's considered the father of stock investing. So it's an opportunity to ask some very important questions of Louis. Louis, I want to start with commodity prices. Commodity prices are starting to rise. Oil is going up. Given this, obviously there are some net winners, but overall, will this be a negative for individual investors? And how can investors play this to make money and not lose money?
Well, we have a strong dollar in the last few months, and normally a strong dollar will start to push commodity prices down because commodities are priced in dollars. That's already happened on copper, for example. But you've seen and food's been pretty well behaved as well. But you've seen crude oils going higher because of the impending Iran sanctions and, supply fears and Venezuela and other factors. So we don't see the commodity inflation impacting the CPI and things like that yet, okay? The Fed has basically said they see steady inflation. The Fed has a 2% inflation target. The personal consumption expenditure index, they got their own index, and they finally hit their inflation target for the first time since 2011. I think they just want to hold everything steady right now. They've gone from accommodative to neutral. They're at their inflation target. They're going to raise rates if market rates go up, so we have to keep an eye on that. But I think the Fed's just shocked how well it's working. This guy Jerome Powell that runs our Fed was handpicked by Steve Mnuchin, the Treasury Secretary, to be more market friendly. And he said this week that he's just pleasantly surprised how well everything's going. And so I hope the Fed, doesn't go too fast. And I think Powell's been trying to be as gradual as possible.
Okay, well, as we speak, the market is jammed up and a bit fearful of the Fed actions that you speak of. Is it possible that the Fed tightening could cause not just a hiccup, but a retracement in this market?
Absolutely. I mean, the stock market has to compete with interest rates. So if Treasury yields back up, they're going to demand lower price-to-earnings ratios. But price-to-earnings ratios are pretty low because we haven't gone up as much as earnings. The other thing is your Treasury interest is taxed at 40.8 federal, and your dividends are taxed at 23.8 federal. Those are the max rates. So if I'm a wealthy person, I might want to just invest in the stock market because my after-tax yield is going to be higher than if I put the money at the bank. So, I think it's a bit of an overreaction. I think there is a mechanical problem, though, because a month ago our bid-to-cover ratios at the Treasury auctions were 2.8 to 1. They slipped to 2.4. Is that because China's not bidding anymore because the trade spat? And, that's why interest rates are rising. There's fewer bidders for the Treasuries. But, the U.S. is the oasis in the world. There's a lot of foreign capital coming here. We expect that foreign capital will eventually migrate into the Treasury markets, shove yields lower. So we'll see. I think we're going to be okay. It's just, it's interesting. I don't have any fear of inflation longer term. I think we just want to hold everything steady, and that's what the Fed wants to do too.
Now, a question that I always hear has to do with bank stocks. Can you give us some insight in this environment of rates tightening, of some inflation, of being at a market high? Is it a good place right now to be in JP Morgan and Goldman Sachs, or is it the time not to be in them?
I'm an ex-banking analyst, and I was a banking analyst when we had an inverted yield curve and they were all losing money, and I could take two money-losing ones and merge them together, and I kind of cooked the books because they made money when I was done with them. So I haven't bought a bank since. The money center banks are very sensitive to the yield curve. The regional banks are okay if they sell out. I really think that, to be honest with you, the yield curve's way too flat for the banks right now. I think there's better places to go. If you buy banks, you want the dividend yield.
Okay.
But MasterCard, Visa, American Express, PayPal, these are all financials that aren't really
And hitting
banks.
52-week highs.
Yeah, those would be things you could go to. But the money center banks, it's a tough job. You know, a lot of these banks don't even know who their customers are anymore. Everybody's a number. It's all ATMs and online stuff. It's tough. It really is tough. And and you know, they have all the regulatory scrutiny on them. You know, as Wells Fargo found out the hard way. So you know, obviously, JP Morgan has a great cheerleader in Jamie Dimon. So.
Okay, well, thank you very much. We've been speaking with Louis Navellier here from the Dallas Money Show.